Good morning, everyone, and welcome to our Saxo's Global Markets Call. Today is Tuesday, December the 6th, and we'll start with Asian session update from Edmund in Singapore.
Thank you, Akmal. So Asia equities were broadly higher following overnight gains in Wall Street, while the Nikkei was supported with dollar yen fighting support at 113.5. The Kospi was the outperformer in Asian equities at up 1.3% as President Park agrees to resign in April, while opposition lawmakers say they have enough votes to impeach her in a motion set for this Friday. So I seem to have focused on the positive economic data flowing out of the US, with the US ISM non-manufacturing PMI coming in strongly, a high for the year, while the Fed labor market conditions also came in above expectations, clearing the way for a Fed rate hike next week. US dollar index sold off yesterday, while Euro reversed its Asian session decline to close the day higher at 107.63. Suggesting that a no vote for the Italian referendum had been priced into the market. And lastly, we had the RBA holding its horses at 1.5%. This was widely expected, with the Fed almost certain to trigger the US rate hike next week. While the RBA also acknowledged the rise in commodity prices, which will be a positive for national incomes. The RBA governor, however, kept his options open and stated that the bank saw a remote possibility of a rate cut soon. And with that, let me hand it over to John Hardy. Thank you.
Thanks. John Hardy here. First of all, our key events slide. Not a lot today. Actually, that looks like I've not updated today, or I have, except for this item here is wrong. It should be Canadian trade data on this 1330. Sorry about that. Other data is correct here, and key speech is tonight. I had it earlier this week. I had it as for Thursday. It's actually tonight, Wednesday, in New Zealand for this RBNZ's Wheeler speech. A bit of an interesting one there. He probably is going to say something pointed, as this was a late scheduled speech, and it could, supposedly some are talking about it being something hawkish because of housing risks, etc., a bubble in the making there. However, I'll get to that in a moment. Just to round out the calendar, we have the OPEC meeting on Saturday. That was an important one that Ola had me put in, and of course next week we have the key FOMC and BOE meetings. But back to his speech. You can see here the actually you can't see it. It looks like it is here. The New Zealand trade weighted index almost back to the all-time highs here, and it has to be very uncomfortable. They've complained a lot about the exchange rate. New Zealand does have a history of having intervened in the market before. There's no talk of this, and there is some talk that they're going to come out hawkish because of the housing bubble risks. But again, with the trade weighted index this high for the currency, you have a hard time seeing how they're going to do that, or wouldn't want to trigger a aggravated further strength in the New Zealand dollar. So are they going to try to talk up macroprudential policies? I don't know, but it looks like it could be a key event for Kiwi crosses, so we'll be watching that closely. In other news, of course, the euro spike was the news of the day, and with perfect hindsight, makes some sense given how well flagged the Italian referendum was as an event risk, and that it was widely expected to be a no, even if that no had a surprising margin. That combined with positioning, and once everybody tried to get out, it was a pretty ugly and brutal squeeze. Also, this comes right before what looks like an important ECB meeting where we're going to see whether they extend the QE, which they probably will, but it's a question of how much, while at the same time peddling the idea that they're going to do a taper longer term. And so we had a bit of a train wreck in all euro crosses. You can see it here. The euro yen was, after the result was clear, tested the 200-day moving average, several figures lower, and then into the day even higher, the new highs of the cycle. An incredible turnaround there. I think in Eurodollar, if we briefly look over there, the perspective is quite interesting here. Yes, it was an incredible day, outside day, engulfing the last couple of weeks, more of action. In the bigger perspective, if you take the Eurodollar rally and then the high 113 around the Trump result, presidential election result, and this low towards 105, we haven't even quite reached a 382 retracement. We're also still below the key 108.50 area. So this could just be a very aggravated rally within the bear market. It certainly needs to find resistance, however, in this area by the end of the week. 108.50 is the max I would be willing to give it. If we're trending up above there and closing up above there for a couple of days, you have to talk about being stuck in that perma range in Eurodollar again. And as Edmund mentioned, I would just underline, quite interesting, we're seeing ISM non-manufacturing, the key services sector of the U.S. economy, really showing strong activity at the 13-month high for that survey. And this is a comparative survey, so things are getting better at a faster rate recently. So that's quite interesting. And the RBA reaction was very muted because the market has already kind of reassessed the policy rate quite a bit higher recently. So the bar for hawkish surprise was quite high there. So I don't expect any big Aussie rally on that unless we get some spectacular further rally in commodity prices. And with that, I will pass along the baton. Thanks.
Thank you, John. So I think the main big trends here is that if you look across the major economies in the world, Europe, China, US, macro data is surprising to the upside lately. In Europe specifically, very pretty upside surprises. Growth is still very low, as you know. We're growing below trend in the US and US and Europe. And China is stabilizing. So but we like when we have surprises. So that's really what's benefiting equities at this point in time. And if we talk about Italian banks from yesterday, it's quite interesting to see the reaction we saw in European equities in general. Very big. Italy not so much, and especially the banks were not very big. I alluded to it. Maybe a little bit too broad. I say it would not be a Brexit play, but you could actually say the rest of the European equity market was actually a Brexit replay with a strong rebound, whereas in Italy it didn't really happen. And I think investors are quite wary at the moment and on the sideline, looking to see whether Monte dei Paschi and UniCredit can actually pull off a capital raise. Keep in mind it's a pretty big figure, so UniCredit is looking for 12 billion euros in capital over the coming weeks. So it's going to be quite interesting. I don't think this story is over yet. If we turn towards the DAX, which is the most traded product here in the equity business here in Saxo Bank, you can see here that we're very close to an entry on the long side in our breakout system. So 10,832 is the crucial level in the DAX. It's taking out the highs from around October before we had the big sell-off into the U.S. election. If we can get above that one, we can easily clear the way all the way to 11,000 and beyond, maybe even 11,300. If you look at the valuation, European equities are cheaper than the rest of the DM equity space, and you have this positive momentum. So if we sort of can get the capital raises in Italy out of the way, I think actually we have paved the way for gains in Europe. And I said last couple of morning calls that I think actually that European equities could be the outperforming equity segment going into 2017 if we can get these event risk and tail risk off the table. Also, we have strong momentum in miners. As you know, I have a negative view on those one. If we break above 300, for instance, in Glencore, I think it's a very strong signal to the upside, and we have to respect that. So just keep in mind of the levels here. Also, closing the short position in U.S. financials ahead of the FOMC. The P&L on that trade was just around zero, basically slightly negative, but nothing major. If we get a very positive signal for U.S. rates in 17, given the macro outlook from the Fed, I think for U.S. financials could extend the momentum going into 2017 and could actually be a quite strongly performer over the next 3 to 4 months. So, but I will end it here and give it over to Ole on commodities. Thank you.
Thank you very much, Peter. Let's take a look at what we have for us today. Let's not mind. Here we go. Seen a bit of a pause in the oil rally yesterday. Market is starting probably to take stock now. It could indicate that we have seen most of the repositioning that took place after the OPEC announcement last week. That has now run its course. Also, again, we are not exactly being presented with bullish news over the past 24 hours. Data yesterday pointed towards another record month in terms of OPEC production in November, up 400,000 barrels to 34.2. Again, the production rise is coming from sources like Nigeria, Libya, and also Angola, but it basically means that the 400,000 barrels is more than what Russia was prepared to cut by. So really, it is crucial that they get backing from the non-OPEC producers when they meet on Saturday in Vienna. So that is going to be the next focus point. Also, we're seeing in terms of positioning, some of the major ETFs have seen some major outflows, especially the USO, which is the world's biggest oil ETF. But in total, we've seen more than $1.3 billion leave the oil sector through the ETF, so those ETFs which got direct exposure to oil, whereas obviously most of the most of the positive flows has gone into oil companies, and if oil starts to break here, then clearly some of these ETFs reflecting the oil producers have run too far. So so the focus on Saturday, as I said, but also we're seeing the cut so far primarily benefiting Brent. We're seeing an outperformance there. The spread is more than $2 now, because we are seeing producer hedging weighing on the WTI all the way out the curve, especially in 2017 and 18. So producers are taking advantage of these current levels. So in terms of prices, look out for 50-60 to the downside. That's the first key level of support to keep an eye on, but should we see some further weakness, then 49.50 was really going to be the first level of major support to the downside. So all in all, pretty lukewarm on oil now after the rally up. We now need to see the barrels being removed, especially at a time where we got headlines with more barrels coming into the market, and we really need to see that they can step it up and produce a meaningful cut, especially from non-OPEC. Gold has been troubled still, but with rising stocks and yields, and not least the coming FOMC meeting. We have to remember the low point in gold last year was when they hiked rates, but this time around could be a bit different because we are seeing growth picking up, and that raises the risk of additional rate hikes. But at least we're seeing excuse me, we're seeing open interest in the gold futures starting to stabilize. Could indicate that most of the selling pressure has disappeared, and we can also see it by the price action over the past 24 hours. The 1172 level has been pretty key. We slumped through it yesterday, but we managed to make it back above today. So it does indicate that we are starting to see some support coming into the market in this area. But ETF flows down for the 17th day. We need to see that stabilize before we can really start to talk about a meaningful recovery here. But at least it is starting to strike back. But ahead of the FOMC meeting, it may be struggling to make any major progress. So I think I will leave it there and pass it on to the next.